Welcome back, family, to another installment of the Wealthy Wallet Wall Street course. I hope you had a wonderful week. Here we are again on a Saturday doing our thing, getting it in, learning financial information, learning financial literacy, and learning how to create generational wealth for yourself and for your family. And if you find this information to be valuable, please do not forget to subscribe. If you definitely find this on YouTube, because it's YouTube, when you subscribe, it's a way of telling YouTube that you find this content to be very valuable and you want to see more of it. And if you find this on Facebook or Instagram somewhere, don't forget to like and follow. But we're not going to wait any longer. We're going to jump into it. I hope you had a wonderful weekend. Again, this Saturday we get into it. We're not at the club, we're not out partying, but we're learning financial literacy. But today I want to talk to you about numbers because numbers don't lie. You know, as Jay-Z said, check the scoreboard. The numbers don't lie, and you have to know the numbers. That's why we are learning fundamental analysis, and I want to begin to teach you about how to basically break down a company's financial statement. We're going to learn first how to read a financial statement, and then in the next class, we're going to learn how to analyze that financial statement. But before we can analyze a financial statement, we need to understand how to read a financial statement and what a financial statement is. Because again, if we are digging into the numbers don't lie. We can see what a company's doing, how they doing, unless they cheat and scheme and the one company, coffee company in China, I forgot what the name of it was, but we're not going to get on that. But the numbers don't lie, folks. If you dig into the numbers and if you understand the numbers, you can understand whether you should invest in a company or not invest into a company because the numbers tell the story. So let's dig right into it. So as we start our journey on the numbers don't lie and how to read a financial statement, we want to start out with section one because a financial statement is broken up into three different sections. It's broken up into the income statement section, which is where we're going to start out first. So that leads me to ask you, what is an income statement? Well, the income statement is one of three statements used in both corporate finance and accounting. The statement displays the company's revenue, costs, gross profit, selling and administrative expenses, and other expenses and income, taxes paid, and net profit in a coherent and logical manner. So we definitely need to know what the company's bringing in. We need to know what it costs to bring that money in. We need to know what they're paying to their employees, the expenses they're paying out in commission and fees, and the taxes paid. We need to know all that stuff in order to properly evaluate a company's ability to make money, right? We need to know all these things because we can't evaluate a company's ability to make money if we don't know the numbers because the numbers tell the story. You got to know the numbers, folks. You got to know the numbers. So if you're jumping into a company and you don't know the numbers, then you're jumping into it in ignorance. And if you're jumping into it ignorance, I want to be the first to tell you is not bliss. You got to know what you're getting into because you got to learn how to play the long game as well as the short game. And the fundamental analysis teaches you how to play the long game. So technical analysis, what we discussed prior to this, teaches you how to play the short game. But the rich get rich by playing the long game. So I want to teach you also how to play the long game. And the long game is how to understand a financial statement. Because a financial statement not only understands you how a company operates, but it understands you how to operate in your own life. If you want to be an entrepreneur, you want to be self-employed, you gotta learn how financial statements work because this is also going to be a part of your business and a part of your life, right? So we want to understand first how the income statement is and how the three statements are used in corporate finances and accounting. All right. So before we go to the next statement, I want you to let's go ahead and join with me. Let's go to yahoofinance.com. Let's see. Let's go to yahoo.com, right? Then we're going to click on the finance tab. Let's do this in real time. Let's evaluate a company in real time and click on finance. And then let's do Apple. We're going to do Apple because they have pretty much everything. All right, so let's do Apple. Then you go to Apple, and then we're going to go to financials. Click on financials. This is real time. And we're going to first look at, you see it broken up into three sections: the income statement, the balance sheet, and the cash flow. And we're about to talk about the income statement. All right. So let's go ahead and dig into it. And then this is also recorded in thousands, right? So we know that the total revenue of Apple, they produced $273 billion in income. So they made $273 billion in revenue. This is the money that they made before they paid out anybody, before they assessed the cost of goods, before they assessed the cost of producing the products. This is the money they made from selling everything that they sell, or their services, or their assets. This is the money they made. So the total revenue that they came in, the total money that they made come into their doors, into their bank account, was $273 billion, 857 million, right? So, but the cost to produce $273 billion in income was $169 billion. So it cost them $169 billion in order to produce $273 billion in income. Let me say it again. It cost them $169 billion in order to produce $273 billion in revenue. But I want to start out here. I don't want to do the 12-month rolling average. I want to do the actual fiscal year. So I'm sorry. Let's go ahead and jump here. So, but you understand what I'm saying. So it cost them so they made, and at the 9/30/2020, the last count of their fiscal year, right? They made $274 billion, right? And the cost to produce that money was $169 billion, right? So it cost them $169 billion to make $274 billion. So the gross profit of those two numbers are $104 billion. So they netted $104 billion. And then the cost of the revenue is basically the production of the production of the product, what it costs to make this product, the manufacturing cost of making an iPhone, an iMac, an iPad, AirPods. This is what it costs them to make those things. So it costs them $169 billion to make the product. And then off the product they made was $274 billion. So it cost them $169 billion, right? And then when they decided to sell those products, they made $274 billion, which leaves a net income of $104 billion. And then, so now that we understand they have a $404 billion in net income, this is after they produced the product and then sold the product. They came up with a net income of $104 billion. Okay, so now we dig into operating expenses. So operating expenses include SGA, which is selling, general, and administrative fees, right? I mean, administrative costs. I'm sorry. So that means they paid out about $19,916 in commissions and salaries and office fees or advertisement and anything that it cost them to get the product out to the world, right? What it cost them to deliver the product to consumers. You're going to need people. You're going to need people in the stores. You're going to need employees. You're going to need people to be able to service customers in order to get that device to the customer, right? So you need people to be able to sell the iMacs. You're going to need staff to be able to account, and you're going to need staff to be able to count the inventory, to be able to count the money. You're going to need staff to be able to sell the inventory. You're going to need staff to be able to sell the products that you produce. So you're going to need people. So, right. And you're going to need advertisement and marketing. So basically the SGA, which is selling, general, administrative cost them $19 billion, right? And not only that, so not only did they did $19 billion in commissions, advertisement, employee bonuses, but so that's what they did in order to, push the product out into the market, into the consumer market. And they also spent another $18,752,000,000 in research and development. As a company, you don't want to be stagnant. You want to continue to better your product, right? You want to continue to increase innovation. You want to continue to bring new products to the market. So you're definitely going to need research and development in your business. You can't stay stagnant, because if you're not researching and developing your product, you're not continuing to make your product better, you're not continuing innovating, then you're going to become obsolete. You're going to become extinct. You're no longer going to be needed. So it is imperative that you also spend money in research and development. So Apple's spending a lot of money in research and development so that they can stay always ahead of the game, right? Their job is to stay ahead of the game. So they spend $18 billion in research and development. Now that we talked about operating expenses, let's jump into operating income. And we're going to talk about non-operating income. And one might ask, what is non-operating income? Non-operating income is income that Apple produced outside of their core business model. So it's income that they produce that was not from selling iPhones, iPads, earpods, or iPods or anything of that nature. It was income that they produced outside of their core business model, which is selling technology, software, hardware. Selling hardware, right? So they produced income from outside of selling hardware, and that income could have come from, loans, mortgages, money they lent out. It could have come from things like that. So let's break this down. So as we maximize this, Apple produced, $3.7 billion outside of their core business model from other from other revenue streams. So they produced $3.7 billion from other areas of revenue streams outside of their core business. And the cost to produce that revenue was $2.8 billion. So they made a net income of $890 million. So Apple made $890 million outside of their core business model, which is pretty good to me. They made $1 billion almost outside of producing an iPhone, an iMac, earpods, or iPods. That's pretty amazing to me. I don't know for you, but that's amazing to me. They jump outside of their core business model and made $1 billion. So, all right, so now let's jump into other income expenses. So now we see that Apple also paid another $87 million in other income expenses outside of their core business model, right? So they must have manufactured a product. They might have owed loans or mortgages on something that operates outside of their core business model, which leaves us with a pre-income tax of $67 billion. So Apple's pre-income tax, this is their income that they made before they paid taxes. They made $67 billion, after bringing in $274 million, they only took home $67 billion of the $274 billion that they made, right? And this is before taxes, right? Because it says pre-tax income. So, and then we show tax provision here is the amount of money. They paid $9.6 billion in taxes. Woo! That's a lot of money. $9.6 billion in company. Your average company is not even worth $9.6 billion. But Apple paid $9.6 billion. So after the $67 billion that they made that before taxes, they paid out another $9 billion in taxes, which left them with a net income of $57 billion. And his net income is basically the bottom line for you or me who are invested into Apple as a shareholder, is the income that our profit or our profit margin will be based on, which will be the equity that our income is based on. It will be based off $57 billion. And that basic EPS, they made $330 per share. And diluted EPS is $330 per share. But I want to talk to you real quick about average shares and diluted shares. Average shares are basically the shares that are currently in the market around. And when you see a company says, okay, their diluted share float or their diluted shares, meaning that the shares that they currently have and the shares that they could potentially throw in the market. So what I mean by that is companies give out shares like for commission to employees or as a bonus to employees, right? And so those shares are no longer, are not yet in the market, but they could be potential shares in the future if the stock or the company hits a certain number. So they give out these shares or stocks as a bonus or as a commission or as a reward. And so since they give out these shares as a reward, that could be potentially added into the coming shares that already exist. So then that's what diluted shares are. Diluted shares are the actual shares that are actually in the market and the potential shares that could be in the market, right? But then it brings us down to the open operating income reported was $62.88 billion, $66.2 billion, $66.2 billion. And Apple's total expenses, and you get the total expenses by adding the long term, short term debt. And then it brings us down to the net income from continuing and discontinuing operations. So the income that they met from their active business and businesses that they have stopped that no longer exist. So, they no longer make the iPhone 5, or the iPhone 4 or 6 or 7, right? So, but this is the income that they produce from discontinued business and continue or active business, right? And the normalized income, same thing. Normalized income is the average income that Apple has earned over a set period of time. So the normalized income usually always breaks down to the actual net income. What you see, $57.4 million, which is the bottom line. It usually always breaks down to the bottom line. And so the interest income, we saw up here when we looked into other interest expenses. Where is it at? Non-operating interest expenses, $3.7 billion that they made, right? We saw that there. And we know that the interest expenses is $2.8 billion, which netted them a net income of $890 billion that they made from money that they lent out, that was paid in the form of interest, as we talked about up here. Whether they, lent out a building that people paid them in interest, whether they lent out money that people paid them in interest, in some way, sort of form, they made $890 million in interest. EBIT stands for earnings before interest and taxes. So before earnings and interest and taxes, Apple made $69.9 billion. So before they paid taxes or interest, Apple made $69 billion. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. All right. So reconcile cost of revenue. So it literally costs. So if we reconcile everything, we put it all together, we understand that it costs Apple $169 billion to make $274 million. Reconciliate these depreciation as $11 billion. So they wrote off $11 billion in inventory, right? And the net income from continuing operating, again, it goes back to the bottom line profit that Apple made, $57.4 billion. And normalized earnings before interest, taxes, depreciation, and amortization was $81 billion. So they made $81 billion before they took out taxes and interest. And if you add those things up, this is what will get you $81 billion. So please DM me if you have any questions. Make a comment in the comment on YouTube, Facebook, or wherever you're listening to this. If you need more understanding of the explaining of the income statement, I'm more than willing to give you all the knowledge possible. But this is just basic knowledge of an income statement. All right. So now let's move on to the next section we look at is section 2, the balance sheet. Let's talk about the balance sheet. What is the balance sheet? A balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity at a specific point in time and provides a basis for computing rates of return and evaluating its capital structure. It is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. All right, so let's take a look at the balance statement. Oops, clicked the wrong thing. Let's take a look at the balance statement, the balance sheet. I'm sorry. So right now, the balance sheet shows us that Apple has a total assets of $223 billion worth of assets. And let's click on here and see how it breaks down. Their current assets, which is their short-term assets, is $143 billion. Their short-term assets is $143 billion, right? And their long-term assets are broken up into $180 billion. Short-term assets, 143 billion. Long-term assets, 180 billion. And when I say short-term, that's meaning assets that produces income within 12-month period. And when I say long-term assets, it's assets that produces income over a 12-month period. All right. So let's see what's in the current assets. So the current cash and equivalents that they have available. So the current cash and cash equivalents is $38 billion. So when I say cash and cash equivalents, so right now they have in the bank $17 billion, and cash equivalents could be like bonds, treasury notes, uh, anything that Apple can actually liquidate and turn into cash immediately. That's what cash equivalents is. They can turn it into cash within weeks or literally a matter of a month. They can automatically turn this money into cash or currency. They can turn it into currency or any monetary value very fast. But right now, we know that the currency that they have in the bank or the actual money that they have in the bank is $17 billion. And they have also another $20 billion that they can turn into solid cash very quickly if they need to get liquid. If they need liquid or they need to liquidate stuff, this is where it is. They have $20 billion that they can liquidate and turn into currency to pay any bills that might be overdue, right? And then other short-term investments, they have another $52 billion that may not turn into currency so fast, right? And then we have also in the current assets is receivables, meaning the people that owe Apple money. Accounts receivables, they have 16, let's see, they have $16 billion. So Apple has lent out $16 billion where people owe them $16 billion, right? And they have another $21 billion that is owed to them in other accounts receivables, right? And then they have $4 million in inventory. But as of right now, Apple could literally pull out the bank or come up with $38 billion in cash in a matter of weeks if they need to. The rest of the stuff, this will take a little bit longer to turn into cash. Accounts receivable. What if the people don't have the money when they go to them and say, "Hey, I need my money. I need you to go ahead and produce that $37 billion." They probably won't be able to get it as fast, right? And then other accounts receivable, 16 billion. And then, this 38.7 billion breaks into these two numbers, right? And then they have another $4 million in inventory out there, which we're definitely going to discuss in next week's session. All right, so then we come down to the current deferred assets, right? And let's go ahead and maximize this. Where is it at? All right, current deferred assets. All right, other current assets is 11 billion and 11 billion. When I say current assets, meaning assets like stuff that they have to like assets that they have that they can turn into liquid and within 12 months. And the non-current assets is uh, assets that they can turn into liquid that would take them longer than 12 months. So that's what those two things are. And those assets could be like, lands, intellectual property as like patents, licenses, property that they might have bought overseas or anything that would take them a little bit longer than 12 months to turn into liquid. And current assets would be like inventory, things, bonds, treasury yields that they can immediately turn into cash, right? All right, so now let's talk about total liabilities. Let's talk about total liabilities. Let me see something else. Yeah. All right, so it's now that we talked about assets, because the balance sheet is also broken down into, three things, two things, liabilities and assets. So the current liabilities, right? And liabilities, remember, current liabilities are always short-term liabilities, meaning debt that they have to repay within a 12-month period. And non-current liabilities is debt that they have to repay after a 12-month period. So let's look at the current liabilities. So we know that Apple has due within 12 months $42 billion in payables, accounts payables. They have $42 billion that they have to pay within the next 12 months. And then now let's look at current debt. They have $13 billion right now in current debt that they also have to pay within the next 12 months. And let's look at the current deferred liabilities. Current deferred liabilities. They have $6 billion in current deferred liabilities that they have to pay within the next 12 months. And current deferred revenue is basically revenue that Apple received from products that customers have not received yet. So let's say you pre-ordered a MacBook that hasn't come out yet, but you do to receive this product. That's what current deferred revenue is. Revenue that they have received from a product that they have not given. You know, everybody always put things on sales called pre-orders, and you know that you eventually get it, but it's income from Apple that they have received that they have not given the product to. All right. And other current liabilities, which Apple, the 42,600 and 48 billion million, I mean, $42,684,000,000 that they have to pay out in total current liabilities. Now let's look at the long-term liabilities. This is, remember, the non-current liabilities is debt that they have to pay out after 12 months, right? And current liabilities is debt that they have to pay within a 12-month period. So the long-term debt would be like, mortgages, loans that they took out. So the long-term debt is $98 billion, right? The long-term debt is $98 billion, $98.6 billion in long-term debt that they have. All right, trade and other payables, meaning trade and other payables are like things that Apple may owe vendors or people who sells them service and goods that they have not paid yet. If people produce the iPhone for them and they produce millions of them, and Apple owes them $28 billion that they have not yet paid out, right? So it's basically money. The sales and goods that Apple has received that they have not paid money out for. That's what trade and other payables are. And other current liabilities, that could be anything outside of the core business model, but that leaves us at $26.3 billion. All right, so let's maximize that back up. And then we go to the total equity minority interest, which is basically the ownership of shareholders that owns less than 50% of the company. Because when you own less than 50% of the company, then you're a minority interest holder. But if you own more than 50% of the company, then you're a majority interest holder. So what is due to the minority holders is $65.3 billion. That is what's due out in equity to stockholders and shareholders. So next we get to the total capitalization. Total capitalization is basically the long-term debt and the short-term debt plus the minority gross equity and interest, right? So in order to get this number, you add the long-term debt plus the short-term debt. So basically, if you add sorry, your current debt, which is your short-term debt, and your long-term debt, and your equity, you'll get the total capitalization of uh, of Apple. And the total capitalization is just basically Apple's capital. It forms the Apple's capital structure, and the capital structure is just basically uh, Apple use capital structure basically to use debt and equity to be able to operate and grow the company. So a company's capital structure uses debt and equity to grow a company and to operate on a day-to-day basis. So let me say it again. Total capitalization is basically a company's capital structure, and they use that capital structure, which is debt and equity, to continue to operate and grow. And then next we look at the common stock equity, which we already talked about, which is 65.33 billion. Net tangible assets is the same thing. This is how much money Apple has available after you manage after you manage their assets and current liabilities. And working capital is basically if you take the short term, basically the money they have left over after they pay a short term debt with their short term assets. And we looked up their short term assets, right? If you look up the short term assets, so if you manage the short term assets, which are current assets, and we go back and we look at current assets, $143 billion. So let's look up their current assets. If you add up their current assets, and then if you minus them from their current debts, you're going to get $38 billion as working capital. So again, working capital basically is when you take a company's short-term assets and subtract it from a company's short-term debt. So it will be the money left over after they paid their short-term debt with their short-term assets. That's what working capital is. It's the money that they have readily available to continue to invest in a business. Invested capital basically is long-term, is short-term debt, and the common stock equity. So if you have long-term, short-term debt, and common stock equity, that's the amount of money that capital has invested and to continue to operate the business and to grow the business. The tangible book value of the company, again, breaks down to the equity, the bottom line, what they have right now. And we look at the total debt, which is the short term and long term. So if you basically let's go. I need to do all that. So if you take the current lab, there we go. The current debt and capital, 13 billion. And then you take the current liabilities, which is their long-term debt. Let's see, long-term debt, $98 billion. And you add it to the equity, you're going to get $177 billion, which will be the invested capital. And then you look at the tangible book value of 65 billion, $65.3 billion. And then again, the total debt is when you take the long-term debt plus the short-term debt, and you add it together, which will give you the total debt of Apple for the year of 2020. And then we get the net debt from, if you take the short-term and long-term debt, and you take the money that they have available right now, if they had to immediately liquidate everything and pay all their debts immediately, right? They only have $38 billion in net and really liquid that they can liquidate. So if you take the $38 billion and you subtract it from the 112, it will get you $74 billion. So Apple will be left. They can't pay all their bills, right? And we're going to explain what that means in the next video, in the next class. But so Apple will be left holding a bag of $74 billion. So if Apple had to immediately pay all their debt right now, they can only pay $38 billion worth of their debt, which will leave them with $74 billion in debt, right? And shared issues, they have 16 billion shares in the market. All right, so now we move to section 3. Section 3, the cash flow. We need to know the money going in and the money coming out, which is a very imperative part of the business. We need to know about the money going in and about the money coming out. All right, so what does the cash flow statement tell us? A cash flow statement is a financial statement that provides aggregated data regarding all cash inflows a company receives from its ongoing operation and external investments. All right, so let's go back over here. All right, so the cash flow statement is literally broken down into 3 sections: operating cash flow, investing cash flow, and financial cash flow. Operating cash flow is basically the short-term assets and short-term liabilities cash flow going in and out. Investing cash flow is basically the long-term assets of the company, and financing cash flow is basically the long-term debt of the company. But let's take a look at the operating cash flow, which is the short-term liabilities and short-term assets of the company. So we say from its core business model, its continued operating core business model, they bring in a cash flow of $58 billion, right? They bring in because there's no money there. Depreciation and amortization, they get to write down $11 billion. And then they got deferred taxes, so money that they're going to have to pay out in taxes, $128 billion. They already paid that money in taxes. And then they have stock-based compensation. So stocks that they may have paid to their employees as bonuses, right? They give out compensations to the employees. Love Apple. They paid $6 billion in compensations last year, right? Let's jump over here. We got to do 2020. But they paid $6.8 billion in compensation, $215 billion in taxes. $215 million in taxes. But they wrote off $11 billion in depreciation and amortization. And we dumped down here. Other non-cash items was $97 million. All right. Then we go into the working capital. So working capital. So Apple has not received $8.4 billion that is owed to them. Their changes in inventory cost them $127 million, right? So, which probably had depreciation and the selling, and then accounts payable. They've paid out $4 billion to people they owe. The change in current assets has been $9 billion. So they paid out $9 billion over their current assets and their current liabilities. They still owe $8.9 billion in short-term debt. They paid out $9.5 billion to accumulate more assets, right? Let me say it again. They paid out $9.5 billion to accumulate more assets, which accumulated $8.9 billion in debt in the short term, which they debt that they have to pay off within 12 months and assets that they bought within 12 months, right? And this is money, again, that they paid off within a 12-month rolling period. Other working capital that they accumulated was $1.4 billion. Let's talk about invested cash flow. And then we're going to the long-term assets, right? And we're going to jump into the long-term assets. We just finished with the short-term assets. Let's jump into the long-term. Let's see. So right now, in the short-term assets, right, they have PPE, which is property, plant, and equipment. So they invested, $7 billion, and maybe they bought another building. Maybe they bought another building. They bought more manufacturing equipment to continue to expand their products. So they bought another building and bought another manufacturing plant. They bought other things in order to continue to expand their product. And then we go down till they probably acquired a business, which cost them $1.5 billion, right? Let's look at that. So they acquired a business. They purchased the business for $1.5 billion. And the purchase of investments, so the total purchase of investments was $115 billion. And they were able to sell some of those investments and made $120 billion, which left them with total investment of long-term debt of $791 million. Right? Long-term investments, which is a good thing. All right, so now let's look at the financial cash flow, which is the third section of the financial of the cash flow statement. So let's look at this and expand it some more. So the net issuance of payments, that they created in debt by like issuing out of stocks to raise more money. So between those two, they did about $73 billion in issuing more stocks and accumulating more debt in order to continue to expand the company. You want to see things like this. You want to see them accumulating more debt as they continue to pay it off to continue to grow the company. Well, again, we're going to dig more and more into this next week class. And Apple, and we see that Apple paid out $14 billion in dividends. They paid out $14 billion in dividends, meaning they paid out $14 billion into people who own Apple stock, and they paid them to invest. All right. And they will look at other financial charges, which was $3.6 billion. Now we're going to minute and the end of the cash position after they've done all these things, because they had a beginning from year 2020, from the year 2019. They came in with this company at 50 billion after total change in cash. After they did everything that they did, it left them with paying out $10.4 billion, which left them with a net income ending cash balance of $39 billion, just like you see the ending statement of on your bank balance, right? They paid out $9.5 billion in taxes, $3 billion in interest, and they paid out another and they paid out another $7 billion in capital expenditures, meaning they paid off more of their debt, and they issued another $880 million in stock, the issuance of debt, which is another 16 million, and they paid another $12 billion. Let me see, that's 16 billion. And they paid another $12 billion in debt, and they decided they wanted to buy back some of their shares, so they paid $72 billion to buy back some of the company's stock, which left, if you calculate all this, it leaves them with a free cash flow of $73 billion. And we're going to talk about next week why that is super good for a company to be left with $73 billion in cash flow. So let's just summarize real quick. We talked about the income statement, the balance sheet, and the cash flow. And it's imperative to know all three of these and how to read them. But we're going to break these down more and more next week. But I just had to go over real quick so that you have a basic understanding of what income statement is. Because the income statement tells you the truth. It tells you the numbers. It tells you where a company is going to survive or fall. It tells you where the company is on the brink of filing bankruptcy, or are they on the company of are they on the cusp of just thriving, just continue to exist for a very long time. So hope you have learned a lot. And basically, don't forget that you can always DM your Wealthy Wallet, right? Or comment in the comment section. We answer all comments. So if there's any comments in the comment section, please feel free. If you don't understand something, we'll get with you right away and help you to understand what you do not understand. But again, Apple's making money. Definitely a great investment. After looking at all this stuff, and they have a free cash flow of 70, and then with a free cash flow of $71 billion, which is pretty amazing. So I'll let you know that Apple's not going anywhere anytime soon, but we're going to dig into why next week. Thank you again for joining the Wealthy Wallet podcast, and I will see y'all again next week at the same time. Have a good night, family.